What's going on, YouTube? Just wanted to catch up with y'all, talk about some things that I'm noticing in the economy and some things that are on my radar, and just to do a tiny bit of a deep dive on some of the analysis that I do and the things that I do to keep up with the market here and there as it pertains to the macro. So as you can see here, this is the Fear and Greed Index. This is probably, the only good product CNN has. But if you just Google, let me see here, you just go to CNN Greed Index. It's gonna be the top one right here. I check this from time to time. Market sentiment is right here. Okay, so I want to talk about cash levels as it pertains to this stuff as well. When the market is extremely greedy, when everybody's buying up everything and the market is pumping and going up, valuations go up. And when valuations go up, more risk happens. All right. So in theory, when when it's greed time and extreme greed time, it's time to have more cash in your portfolio. As averse to if it's extreme fear, etc., and everything's going on sale, it's time to deploy the cash and buy the dip. All right, and you should be having less cash in your portfolio. All right, so here are some things that kind of got me thinking about things. Here are our actual treasury bond rates, all the way from 1 month all the way to 30-year bonds. These are the yield rates that they're producing right now. If you heard the term "nothing is free," I'd assess that to be an accurate term. Where do you think that? Who pays these bonds? Who's it owed to? And what are the repercussions of them when they raise these interest rates? All right. So whenever you see interest rates getting risen, and let's say I buy a treasury bond, I'm actually loaning money to the government. All right. And they use these interest rates to balance inflation, balance supply and demand of the economy. And there's some engineering that they do with the economy with these interest rates. Okay. So as you see, like a 1 month is yielding more than a 30-year. And then as you go down, there's a correlation. Like the longer out you go, the less of a yield you have. This is an inverted yield. All right. But it wouldn't make sense because, the longer the bond rate, the more yield I should get. Yes. But in this case, no, because they have been raising. All right. Now, this is what happens when you raise the bond yields. All right. Here's our government spending. This is from the Treasury website. It's a federal data website, if you will. And as you can see, we have like Department of Defense. This is all of our country's military spending annually. We're spending about maybe 629 billion a year. And right above it, because the interest rates on these bonds have gotten so high, now we're spending well over like 30% more than the actual military defense budget, and we're climbing up to closely climbing up to Social Security, which and Department of Health and Human Services. So if our country is spending a lot of money on these treasury notes, which quite frankly a lot of countries are buying off us, like Japan and all these other countries, etc., there are some repercussions to this. Now, what are some repercussions? All right, I don't know if you've been following my channel. Cut that out, Lestat. Stop that. If you've been following my channel, I've been talking about Crocs and the debt that they have. Remember, their debt matures in 2029 of February. All right. A lot of these companies, they have corporate debts. They have In fact, I argue a lot of them have a lot of high debt levels. All right. So when they refinance, all right, when they get debt, it's pretty much it's corporate debt with maturities. All right, they're senior notes typically, and there'll be the worker rate with the whatever bank, and the bank will turn around and sell derivatives against the debt in the debt market and so forth. That's really irrelevant, but typically these maturities are within 5, 6, 3 years, depending on whatever the company wants to do at the time when they're negotiating with whatever lender. All right. So with these high interest rates, companies that have a lot of debt are coming up to their maturity wall dates. Like in Crocs, their debt is due. Those notes are due in February of 2029. That's 6 years from now. So this doesn't apply to Crocs. Crocs is good to go for the next 6 years. As long as they pay off that portion within 6 years, they're good. And that's something I'm monitoring. All right. These other companies' business models are really high debt levels. All right. I'll make an example. All right. We'll check out Verizon. All right. If you look at just on a real snippet, Verizon's debt is more than what their company is worth. So they owe 128 billion, and they only have shy of 5 billion in cash. All right. So if these companies out there that have high debt levels, that have to if they can't afford to pay the senior notes off in time, they have to refinance the debt. And when they refinance the debt, they got to do it at higher interest rates. All right. And when they do it at high interest rates, the minimum monthly or quarterly payment digs right into the free cash flows of the companies. All right. So a company can make money, and it can translate all the way down to the bottom line through their net income and free cash flows. And the free cash flows are used to pay dividends, pay down debt, do buybacks, whatever. All right. If these companies' cash flows are going towards debt payments, as far as their levered cash flow. So if you look into a cash flow statement under Seeking Alpha for whatever company, and you go to the levered free cash flow towards the bottom, like the fifth from the bottom, this is the company that they have in their free cash flows after they pay their debt obligations for whatever quarter or month or what have you when they report. Okay. So, I mean, these companies, like, maybe their levered free cash flows would appear to be looking good, like they're making good money. But in all reality, when they refinance the debt at higher interest rates, if they refinance at an interest rate of double the interest, their free cash flows might take a big hit, and the market will reassess the multiple or quality of a multiple they're willing to pay for a company. Stock price is going to go down, especially for investors, because all investments are the present value of future free cash flows. Okay. So that's something that's on my radar. What can you do, or what can investors do to avoid this? Not financial advice. What can they do to avoid some of these pitfalls? Look to companies that don't have much debt, that have more cash than they do debt. All right. They're out there. All right. You just have to look for them. Yes, there are not many of them. Let me see here. So Google, I think Google is probably, I guess, the prime example of one, because they have the best balance sheet in the world. But I mean, look at this. They have 118 billion in cash, and they have 30 billion in debt. So if their management decides, hey, these debt levels, these interest rates are getting out of hand, they can pay that off overnight. They can cut a check. All right. So that's how you can mitigate those type of risks. All right. A lot of this is the devil's in the details. So you'd have to go into their um, their quarterly statements on investor, like their 10Ks and so forth, and actually look at the maturity wall or maturity dates of whatever senior notes that are floating around. All right, and make that decision. But companies coming up in 2023, 2024, they hit a wall with these free cash flows as far as they have to refinance this debt and it eats their free cash flows apart. Market's going to go down. It's going to, well, these companies at least are going to trade more downward. All right. And if they don't, they just will become more frothy, or their valuations will be higher and more riskier. All right. So that's something else to consider. When it comes to cash, all right, cash is a position in your portfolio. All right. And well, it's a position in mine at least. And the way I see it is depending on market sentiment and my positioning. Close this ad. I like to have anywhere from 10% to 35% cash. And then typically right now I'm scaling really aggressively and buying more equities. So I'm not going to have as much cash as other people. But that's another thing you can do to naturally mitigate. So if you think some crap is coming around the corner with the macro, and the macro will typically send the whole market down all at the same time, so all the stocks get hit. All right. So it's always nice to have some cash on the side, waiting, some dry powder just ready to deploy when the market just sends everything on sale. All right. So with no zero interest rates, you'll hear the term cash is trash. With high interest rates and liquidity is tightening, cash is king. All right. So that's something to consider. Run your own race. All right. This investing, where I'm a long-term investor, it's a game. All right. That's all it is. It's a game of doubles. It's a game of supply and demand. When you use your cash, the government prints it. All right. So whenever someone tells you you go to work to make money, no money is being made by the workplace. You're earning the money. You're convincing someone else to do the transfer of representation of products of goods and services. Accounting is the documentation of such. So, so I mean that's something to consider. All right. But in the financial markets, when it comes to investing, liquidity equals cash, and it's based on supply and demand of the cash. All right. All right. So as I digress, that's my take on it. Um, I'm gonna be doing some more videos later on. Lately, I haven't been able to. I've been pretty busy, but yeah, if you like this content, like, subscribe, hit the bell notification. You might pick up some things here or there. Not financial advice. It's just for entertainment purposes. But hey, I appreciate it. Have a good day.